context. Maybe connect the dots for the audience on how trade finance is connected to these challenges of low yields and the high cost of holding cash.
Sure thing. So with trade finance, effectively, you have a cash alternative investment. It's 30 to 90 days duration, so it's very flexible. There's a mid to high single digit yields, about 4 to 8, 9% annualized yields. And trade finance is not correlated with the broader fixed income markets, the equity markets, the real estate markets. For folks that are investing in trade finance, they're not really taking on market risk. The risk they're taking on is more sort of contract risk. So I think to just step back for a second, what is trade finance? Sort of very simply put, if you have a seller, a business that's selling goods or selling services, and that business has consummated the sale to a buyer, another business, then there's a payment obligation that arises from that buyer, and that payment obligation is a trade receivable. And interestingly, so let's take an example. If you have an Indian rice exporter, they're selling to Costco, they have effectively procured rice, they packaged it, they've shipped it, and they're waiting 90 days for Costco to pay them. That's a 90-day trade receivable. Interestingly, trade receivables have been surprisingly resilient and very stable across economic cycles. So they've outperformed during recessions, mortgage-backed securities, CMBS, credit cards, other types of personal loans. And there are a couple of key reasons for this, really 3 key reasons. The first, I would say, is that with trade receivables, the financing is tied to a transaction that's already been completed. So there's no sort of production risk, timing risk, or fulfillment risk. There's just waiting on basically receiving a payment. The second thing is, because trade finance is tied to a specific transaction rather than the financial health of the business, investors not taking risk on a business cycle. They're not taking some risk on sort of macro events, not taking risk on how the financials of a company may evolve or devolve over the next couple of weeks, months, or years. The exposure is really to that particular transaction. And so this reduces the risk. And the third piece, which is important, is that we're talking about a 30 to 90-day duration asset. Our book is on average about 50 days. And so a trade finance manager can very quickly rebalance their portfolio in the face of, let's say, macroeconomic uncertainty. So for example, we've seen a decrease in sort of performance for ready-made apparel, for consumer discretionary goods, and a lot more demand for consumer staples. And so we've rebalanced our portfolio away from textiles, away from apparel, towards more consumer staples, food staples like rice and like packaged food. So there's a quick rebalancing that can occur with trade finance, which can really sort of reduce the level of risk. So I'd say that sort of these are sort of the main characteristics of trade finance, I think, that are important. And I think that, when we look at sort of, we talked about scarcity. So the interesting thing is, we're talking about trade finance because a lot of people haven't heard much about it. And part of the reason there is because most trade finance origination is dominated by very, very large banks like Citibank, like HSBC, like Standard Chartered, because they have a very large global footprint, a large sort of international presence. And those trade finance assets sit on their balance sheets. So there's actually really 10, 20, $30 billion of investable trade finance assets that are available to non-bank investors. Contrast that to the mortgage market, where you have $8 trillion of securitized investable assets. And so there are very few managers that are able to sort of, in a scalable way, make trade finance available to the broader investment community. And that's something that DRIP has been sort of very focused on.